Hi, this is Kathleen Uckert. I'm a senior analyst here at Value. Another senior analyst, Alan House, joins me today. Today we are going to provide an update on the economy and stock market. We will then discuss our Value Line Select, Dividend, Income, and Growth product, and finally, answer any questions you may have. Please note that this presentation will be available on our website, www.valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including all the equities under our coverage. Value Line does not execute trades for its subscribers and therefore has no stake in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer, our different tiers of subscriptions, that information can be found at valueline.com, or you can call 1-800-VALUE-LINE. Now let us discuss the economy and the stock market. Value Line's economic staff prepared this content. The March Consumer Price Index, or CPI report, signaled that inflation is still running hot. Specifically, the CPI and the core CPI, which excludes the more volatile food and energy components, both rose 0.4% month to month, topping the expectations calling for 0.3% increases. On a 12-month basis, the CPI and core CPI increased 3.5% and 3.8% respectively, with both readings above consensus forecasts. This situation bears watching, given the recent surge in commodities prices, particularly in the energy market. The odds of the Federal Reserve cutting interest rates at the June Federal Open Market Committee meeting tumbled on the CPI data, and the prognostications for multiple rate reductions this year are down as well. Treasury market yields jumped on the report, which typically has not been good news for stocks. The employment data will not put pressure on the Federal Reserve reverse monetary policy course either. The nation added 303,000 jobs in March, which was well above the consensus forecast of 200,000. That, along with the unemployment rate remaining relatively unchanged at 3.8%, was another indication that labor market conditions are still tight. The U.S. economy is expanding at a solid pace. The continued rise in job creation has supported consumer spending, which rose 0.8% in February. That, coupled with an expansion of manufacturing activity in March, following 16 straight monthly contractions, has pushed talks of a possible recession, which surfaced in early 2023, further into the future. At worst, it appears that the Fed may be able to navigate a soft landing for domestic economy. First quarter earnings season is now at hand. Wall Street will be examining the latest round of results and commentary from the leading banks for signs of any building stress. Overall, the consensus forecast is for S&P 500 first quarter profit growth in the neighborhood of 3%. We think earnings gains will be needed to justify the S&P 500 index as an elevated price to earnings multiple, which stood above 20 entering earnings season. In conclusion, with growing uncertainty about when the Federal Reserve will begin monetary reign, we still think a portfolio of mostly high-quality stocks and cash equivalents prove astute. On that note, Value Line is providing a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking system, and other valuable services. In addition, Value Line provides a great deal of daily content that can help you avoid the pits and profits during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website. Again, that is www.valueline.com. I will now show you how to access it. Once signed in, head to the dashboard, where I am already located. This is the main landing page for subscribers. Under the quick links, click on Supplementary Reports. As you can see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. Some individual companies incurred a lot of debt or sold stock to improve liquidity over the last few years, especially those dealing with sharply reduced demand for offerings and supply chain problems, among many other issues. Due to the changing structure of company balance sheets, Value Line has been reviewing and altering our proprietary financial strength grades for the stocks in our covered universe. These changes are posted each week in our Selection and Opinion newsletter. For those of you who do not know, financial strength, along with price stability, another proprietary Value Line measure, are the two metrics that are used to calculate the stock safety rank, a key measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information concerning our proprietary ratings, Value Line provides a user guide that can be accessed via the investment education of our website. Lastly, this is a good time to mention that the case for individual stocks is quite strong over broad index funds. Now let's turn our attention to the Value Line Select Dividend Income and Growth product. From the dashboard, where I am now, we will click on Dividend Income and Growth on the right under Quick Links. I will now click under Previous Recommendations as we are highlighting Meta Platforms, our April recommendation. We will now click on Meta Platforms and guide you through the report. Following the front cover, we have a table of contents with the layout of the product. It also gives you a brief description of the companies reviewed in the issue. The Dividend Income and Growth product has both a featured pick and alternative pick. The featured pick is generally a household name with strong operations and the capability for above-average future dividend increases. The alternative pick, while financially sound as well, is a bit of a thinking outside of the box type of pick, which, although meets our parameters, might be viewed as a more unique selection. The next section is a note from our economics department. In this section, we provide an insightful look into how the economy affects our stock selection and portfolio allocation process. Our view is updated weekly in the Value Line Investment Survey. The next section is a detailed report on our featured selection. We generally have a description of the company, a bit of history, along with the current state of affairs and an outlook for the future. We also close with an investment thesis for the selection. Other notable attributes are our sales, earnings, and dividend projections for the stock, along with a company profile. And we also have a graph that depicts share price changes, the 3 to 5 year target price range, and Value Line's proprietary cash flow line. Following the featured presentation, we go right into our alternative selection. We use many of the same components that are included in our featured presentation. And then finally, we wrap up the report with our portfolio updates. In the portfolio update section, we start with an overview of the broader market, averages, with special attention to the S&P 500 index, which is a benchmark we use for our dividend income and growth portfolio. Important topics include corporate earnings, interest rates, and inflation. We then dive into each of the portfolios, featured and alternative, and discuss their performances relative to the benchmark, along with stocks that have markedly outperformed or underperformed over the past 30 days. We also discuss stocks that have recently been sold. Subscribers to the Dividend Income and Growth product receive an audio text to their phones and an email as soon as the security is sold. Value Line also provides supplementary reports on all of the featured selections when quarterly results are announced. As you can see by the list, the past quarter has been quite active. Here's an example of Goldman Sachs, which reported earnings just a couple of days ago. We will now turn our attention to Meta Platforms, highlighting some of our analysis from our April growth report. Shares of Meta Platforms have been stellar performers over the past, handily outpacing Value Line for that period. This comes as little surprise to us, given the company's strong relative results last year and a promising outlook for the year ahead. Meta's share price has climbed substantially over the past decade as it traded in the range of $17 to $45 during its inaugural year as a publicly traded company in 2012, while it passed the $500 mark in early 2024. While the stock clearly leans toward the growth end of our dividend, income, and growth portfolio, the board of directors recently approved a quarterly dividend of 50 cents a share. The first payout will occur in late March. Meta is flush with cash, and though research and development and other costs are high, the dividend ought to be well covered by free cash flow. Although the yield is nothing to write home about, it is an added bonus for shareholders, and we look for increases in the payout over the long term. The steep escalation in share price over the past decade is largely due to a market uptick in earnings per share over the same period. In 2013, for example, earnings per share were 60 cents, while the bottom line clocked in at $14.90 a share last year. A sharp increase in the number of Facebook users over that period was a contributing factor, which helped to boost advertising revenues. In fact, advertising accounts for nearly 98% of the company. To put things in perspective, the number of ads 28% which is on the heels of an 18%. Meta reported fourth quarter 2023 results in early February, and its share price popped on the good news. Looking at it more closely, the company announced revenues of approximately $40.1 billion, which marked a 25% increase over the prior year's tally. Earnings per share came in at a record $5.30, which trounced 2022's comparable period tally of $1.76. Daily active users and monthly active both increased at a mid-single rate for the period. Furthermore, ad impressions delivered across the company's family of apps climbed 21%, and the average price per ad grew slightly. Despite higher research and development expenses, aggregate costs declined somewhat, thanks to lower cost of sales, marketing expense reductions, and reduced general and administrative expenses. The improved expense structure, combined with the higher revenues, helped to shore up.
Hey, Kathy, I'm sorry. We're having trouble hearing you. I'm gonna take over now. I hope everyone can hear me better.
Okay.
Apologies. This is Alan. The improved expense structure combined with higher revenues helped to shore up operating margins for the period. The good times appear likely to continue in 2024. For the first quarter, revenues are expected to be in a range of $34.5 billion to $37 billion, while the value line estimate is closer to the higher end of that range. For the full year, we look for revenues of $158 billion and earnings per share of $20. Both figures would represent records for Meta Platforms and are 17% and 34% higher than 2023's figures. Meta Platforms stock is a solid choice for investors seeking a technology holding to round out their otherwise diversified portfolios. The company has a strong record of growing earnings, and we look for that trend to continue moving forward as the company continues to demonstrate it can capitalize on its enormous user base. While the stock's dividend yield falls below the average equity under our review, we believe that further increases in the payout are likely down the road. Given likely strong cash flow from operations, in the meantime, probable 3-year average earnings growth ought to push these shares considerably higher over the 3 to 5 year investment horizon. Acquisitions, while not included in our projections, could add meaningfully to profits over the long term. A healthy balance sheet and good cash flow from operations should provide many opportunities for internal and external growth over the pole to late decade. We will now answer any questions you may have. Some have been submitted prior to the presentation. Thank you. Alan here once again. We had one good question come in before the presentation started, and that had to do with the dividend trap and how to avoid dividend traps. And that is an excellent question that definitely caught my eye. And the thing with avoiding a dividend trap is, for those who don't know, a dividend trap is a company or a stock that pays a very high dividend that is unsustainable. So, that can definitely happen because, a dividend yield is basically the dividend per share divided by the share price. So if the share price is falling and they're hanging on to their dividend, the yield's going to spike, but it may not be sustainable. And we've seen that definitely in struggling economic times and things like that, where all of a sudden a company will have like a 10% dividend and someone will be like, wow, 10%, I could use that. That's good income. I'm retired or what have you, and that would be excellent income. But the thing with that is it could be, like people call it, a dividend trap because, especially with companies struggling financially, it's not going to be sustainable. And there could be a dividend cut or even an elimination of the dividend, so that's something to definitely look out for. And during our selection process for both our alternative and our featured selection, we make sure that the stocks we are selecting are financially sound, that there's, no dividend trap or anything like that. The dividend is well covered by profits, and that the growth potential for the dividend is above average, going forward. So that was a very good question. Thank you. There's also a question regarding, when we sell a stock, and there's no hard and fast rule for that. As we know during our presentation, our subscribers to this service, they do receive an audio text notification and an email when we sell a stock from the portfolio. There's no hard and fast rule, but we do have a 20% stop loss in effect. So if any of our stocks do hit that threshold, they are automatically sold. So that's one thing. Everything else is a little more subjective. I mean, if a stock's appreciated to the point where we don't think it has, much legs left under it, perhaps we'll sell it. If the of course, if there's in this service especially, if there's a dividend cut, we'll definitely take that. We'll probably sell the stock if there's a dividend cut or any kind of, maybe considerable slowing in the dividend growth. So those are all things that come into play, but there's no, other than the 20% stop loss rule, there's no hard and fast rule as far as when we sell a stock. Someone else also said, is TOL your second choice? And they're talking about, that's Edward. He's talking about that's actually the alternative selection. And I don't know if I'd really call it a second choice. I mean, we do a featured choice and an alternative choice. We like to call it the featured and the alternative. The featured is like more, maybe, a more well-known name, and whereas alternative might be not something you'd think of right away when it comes to dividend income paying stocks. So we don't call it like a first and a second selection. We like to call it a featured and an alternative. And like we noted before, alternative is, maybe a little more thinking outside of the box kind of thing, as far as, dividend income growth. Kathy, do you see any questions that caught your eye?
Uh, I don't know if everyone can hear me. I noticed that the sound quality was so poor, so I apologize for that. I'm not sure.
Okay, that's okay, Kathy. You're still breaking up some. I'm sorry. But as far as our stock selection process, we look at many many factors for both our featured and our alternative selection. Obviously, we look at the dividend growth potential. We look at, the safety ranks on the stocks. We look at the dividends and net profits, how much the company can pay out. If a company, there's no hard and fast rule as far as dividends and net profit, but if a company, usually you don't want the company to pay out more than maybe 40 or 50% of its profits as dividends because it might not be sustainable for the long run. Of course, um, there are some, variations to that, but that's generally the rule of thumb. We also look at the timeliness rank. We also look at, the 18-month appreciation potential. We look at 3 to 5 years appreciation potential. And for those of you who don't know, about probably 6 or 7 years ago now, we instituted the 18-month appreciation potential. Violin was always known for his timeliness ranking and the 3 to 5 year appreciation potential. But now they instituted the 18-month, which is for people with more of an intermediate term investment horizon. But those are all factors we consider, when picking the stock for both the alternative and the featured selection. I believe that's all the questions that we have. I thank you all for joining us. I'll